Hi, everyone. Peter Lynch again. Hope you're doing well. As we said before on the earlier video message, we're going to start using this as a platform to get information out to clients and prospects. The information is flowing very rapidly right now. There's been a lot of changes and updates. I just want to make sure everybody's up to speed on everything. So again, as I said in the earlier video messages, if you want to opt out on this, please just send an email back and respond and say, please take me off the list. If there's an email address that you want to opt in, or somebody that you know that would find a benefit to these emails, that'd be great. Just send us their email address. And of course, you can always just forward the link to anybody who's sitting around the house with some downtime. All right, so hopefully this will help them a little bit. So we're trying to keep these videos short and sweet. So today's message is going to be more about some of the updates that have occurred with the required distributions and tax filing. So the CARE Act, stimulus plan, whatever you want to call it, the CARE Act stands for I wrote it down, Coronavirus Aid, Relief, and Economic Security Act. That's what the CARE Act means. I think that's why it took so long to get through Congress, because they had to come up with this acronym that made sense. So CARE, all right? So Coronavirus Aid, Relief, and Economic Security Act. So that's what we're talking about. So a big provision in there is they have waived requirements for the required distribution in 2020. So it means you don't have to take them, whether it's an inherited IRA, whether it's your regular IRA, company plan, 401k, 403b, all of those have been suspended, waived, whatever you want to call it. You don't have to take it this year. And that's critical now, especially only 3 months into the year. Had they done this in November, December, most people probably would have taken it already. But this is a very big planning opportunity for people, number one, that don't need to take out any more. And again, the M in RMD is minimum, so the required minimum. So the opportunity here now, and the reason that they do this is because back in December, the balances on these IRA accounts, 403bs, 401ks were very high, and you have to take a percentage of that based upon that balance. Now people are saying, well, my accounts are down 30, 40%. This is really going to kind of decrease or reduce the amount of money I have in my IRAs if I have to take out this percentage based upon last year's balance. It's really going to deplete that account. So it's a good thing. They did this back in 2009. I'm not sure if you remember that, but the same concept where the market was down so much and they were forcing people to take money out of their plans. So it's a good thing, and it's a good planning tool now, because if you were only taking out the minimum, you were going to show that income in your tax return. So you'd have to pay tax on money that you really didn't need. So now what the opportunity becomes is maybe you can start doing some Roth IRA conversions. So instead of having this big tax bill that you really you didn't want to add too much more money to the tax bill, now the required distribution is not going to be a taxable event for you. You might be able to start looking into Roth conversions. So that's a good opportunity to add some taxable money to your account, because the double whammy is you don't have the income from the IRAs, but you also, your market value or your account values might be lower. So if you have individual shares of stock, you can just move those shares over. Or if you want to just make a transfer, your balances might be as low as they've been in quite a while. This is the time to make the move to the Roth IRA. You move it over when it's low, and when it goes back up, all that money is now never taxed. So you take money that was forever taxed and you move it to never taxed inside the Roth IRA. All right, so that's one big planning opportunity. The other one is qualified charitable distributions. So you're still going to be able to do qualified charitable distributions. What that is if you're over 70 and a half years old, you can take money out of your IRA accounts, not take it out, but have the IRA custodian send the money directly to your charity of choice. And that is not a taxable event. So you can do that up to $100,000 every single year. That's still in play, even though you don't have to take out the money. But if you're charitably inclined and you want to use that money, by all means, do it. So you can still continue to do that qualified charitable distribution plan. There's really no downside for the waivers of these RMDs. It's just your balance is going to hopefully get back to where it was. So there's no disadvantage to not taking it. Now, if you need the money, you can always take it. So there's no problem in continuing to take it, but you can now control the tax bill for 2020 on a lot of your IRA distributions. The last part of this, there was the tax filing. So the tax filing got extended to July 15th, not only filing your taxes, but also paying your taxes. This is huge. So we've been telling a lot of clients, still do your tax returns if you have them. If your tax preparer is around, let them, they're not going to be going crazy with busy season this year, so they're going to be able to get to it when they can get to it. But the payment of it, so the payment of it is pretty interesting. If you have the money and you want to pay it, just pay it and be done with it. We've been counseling a lot of clients by just saying, stay liquid. If you have the money and you owe the money, this might be a time to just sit on it for a little while and just see how this pandemic kind of plays out. We don't know how much longer this is going to be. If this drags on and on, you're not going to be able to get the money back from the IRS. So I would hold it as long as you're comfortable with holding it, and then just send the check in on July 15th, 14th, 13th, whatever it might be. But this might be a good time to stay liquid. All right. So that's the two planning tips for today. Is the required distribution has been waived. The tax filing penalty or deadlines have been pushed back as well. So either one of these, give me a call. We have a virtual calendar on the bottom of this email that you received. If you ever want to talk to me, just click it, find a time that you can talk, find a time that we can do a virtual meeting. You can always just respond to the email as well, or call or email me directly and just say, hey, I had a question, can we set up a time or something like that? So trying to be out there, trying to be able to communicate with you so it works both ways. So if there's any questions you have or any clarifications you need from me, please don't hesitate. Call me, leave a voicemail, send an email. Okay. That's it for today. So God bless. Stay safe, stay healthy, and let's keep moving on forward with this stuff. All right. Talk to you soon. Thank you.